Good morning. We will do the question on inventory in this session. So the first thing that you have to look at is which method are you using, and that's the FIFO method. So it means the first things that you buy will be sold first. And then secondly, you have to determine whether you use the periodic or the perpetual inventory system. If we look at the first question, they want to know what is the value per skateboard on the 1st of July. So you have to look at your opening inventory, determine that the total value was 120,000. You have 60 units. So if I divide the 120,000 with the 60, it means the skateboards, the cost price was 2,000 each. In the second question, they want to know what is the value of the inventory at the end of the year. So it means I must now determine how much inventory did I have available, how much did I sell, and what is my closing inventory. So if I look at this question, we had 60 units, and that 60 units cost 120. 630 cost 1302, and we returned 5. So just take all those figures into account. So if I want to know how many did we have available to sell, it means that I must take the 60, the 630, and minus the 5. So first of all, we will calculate the total number available for sales. And that is the opening inventory, the 60, plus the 630 that we purchased during the year, minus the 5 that we returned, and that gave me 685 units. Okay, how many of these units did we sell? And they indicate to us that they sold 450 units. So I must subtract the number sold from what we had available to see what is my closing inventory. Okay, that gives me 235 units. Okay, now this is first in, first out. So it means that the goods that we bought first is the ones that will be sold first. So when we sell and we want to calculate the cost of price, we will start with the opening balance, then the first purchases, second purchases. If we want to know the closing inventory, it means the things that were not sold. So this 180 that we purchased in May were not sold. So I will take the 180 times the price of 2,100, and that gives me 378,000. Okay, the total number that we sold was 450. So now I must subtract that, and it gives me another 55 units. In my closing inventory, we've got 235. So if I subtract the 180, there's 55 units left over, and that will be left over from the second last purchases, so the ones that we bought at 2250. So I will multiply that with 2250, and that will give me 123,750. And if I add, it means that my closing inventory is 501,750. Now we have to calculate the cost of sales. So that means we have to take the opening balances, so the ones that we sold first. And the 60 we determined cost 2,000. So I will take the 60 times 2,000, and that will give me 120,000. The second purchases will be sold secondly, so that is the 250 times the 1,900. and that will give me 475. Okay, then the next lot will be out of this that I bought for 2250. Now I must determine how many units did I take out of this bundle. Okay, our total sales, they said, is 450. Of that 450, we've taken 265 from the first two bundles. So if I subtract this, it will tell me how many did I take from the last bundle. Okay, our sales was 450. We took 60 and 250. Sorry, this one must be 250. And then if I subtract that, it means that we took 140. So that first lot was 310. Of the 450, I've taken 310 out of the first two bundles, so it means out of the third purchases, we will take 140 to sell. And that 140 costs 2250. And that will give me 315,000. So if I want to know what is the cost of sales, I will just add this and it will give me 608,750. Okay, if we want to calculate the gross profit, this is going to be easy now because we've already calculated all the figures. So for the gross profit, I will take sales, cost of sales, to determine the gross profit. Okay, my sales is 450 units and the sales price is 3375. So I will take the 450, multiply it with the 3375, and that means my total sales price is 1,518,750. My cost of sales we calculated as 910. Okay, so the cost of sales is 910,000 and my gross profit will then be 608,750. Okay, now they want the markup that we made on this. So it means that I have to go and calculate what is the markup that we made. So I'm going to take my gross profit, the 608,750, and I'm going to divide it by my cost of sales of 910,000 times 100 over 1, and that gives me 66.9%. So this profit is profit on cost because I took the profit and I put it onto my cost price. They could also ask you to work out the percentage profit on sales price. So it would be 608,750 divided by the sales price times 100, and that would give me 40.1%. This would be profit on sales price. Now, what you must remember, sometimes when they do calculations, so this is just to increase your knowledge, they tell you sometimes that the profit is on cost price and sometimes profit is on sales price. If the profit is on cost price, then the cost price equals 100%. The profit would equal 66.9%. And the sales price would be 166.9%. If we say that we have to do the profit on sales price, then the sales price would be 100%. The profit would be 40.1%. And if we subtract that, the cost price will then be 59.9%. So it means if I, for instance, know the sales price or I know the cost price, I can calculate the other one. So if I take the cost price and I say, okay, the cost price was 910,000, then to calculate the sales, I will say 910,000 times by 166.9 divided by 100. If, for instance, I want to know what is the sales price, when I use this percentage, it means the cost price will still be the same, the 910,000. And if I want to calculate the cost price here, I will take the 910,000 times 100 divided by 59.9%. And then I can calculate my sales price. Okay, then they want to know what is the stock turnover rate. Now, for the stock turnover rate, they normally ask this in analysis and interpretation, but they can also ask the rate of stock turnover or the time that you will have stock available to sell when they give you a question on inventory. So remember, you mustn't just split them up in little boxes and things. They must always be at the same place. They can be asked here. So if it's the rate of stock turnover, turnover is another word for sales. What goes with sales? Cost of sales. So it means to know this formula, I will take my cost of sales and I will divide it by my average inventory. Okay, the cost of sales we calculated as 910,000. Then my average inventory is my inventory at the beginning of the year, and they gave me the inventory at the beginning of the year as 120,000. I calculated my inventory at the end of the year the stock on hand at the end of the year was 501750. So it means that I must add that to my inventory. I want to calculate the average, so I will add those two and divide by 2. That will give me 910,000 divided by 310875. And that means it is 2.93 times per year. That is very bad. So it means that they are selling these things so slow that they are can have a lot of losses in the business as a reason of theft, for instance, or that it's broken or damaged. They have more expenses for storage, for insurance. And why do you want to keep such a lot of stock on hand? So that is the main reason, because they sell so little bit of these things, that the inventory actually increased from the beginning of the year from 120,000 to the end of the year of 501,750. So they're just getting more and more stock, but they're not selling the stock. So they will have to do something to see how they can sell this stock so that they can reduce the stock, so they can have special promotions like 3 for the price of 2, or they can, for instance, have an annual sale where they sell all the old stock to try and recuperate the money that they need. So they have to take measures to get rid of this old stock and to improve this. Now, sometimes they also ask you to do the holding time. So how many months or how many days do you have stock available? So stock availability. So how long will we have stock to sell in the future? Okay, here it goes about the inventory. So the inventory will be at the top and the cost of sales will be at the bottom. Now, these two calculations, you always get confused with the formula because they're very similar. So remember, if it's on turnover is sales, then cost of sales will go at the top. If they want to know how much stock do you have available, then it's about inventory, then inventory will go at the top. So it means the inventory is that 310875, and your cost of sales is now the 910,000. And if you want to see how many days it's going to take you to sell it, you will multiply it with 365. And that will give me 124.7 days, or I can say 125 days. So I've got stock available for the next 125 days. That is really ridiculous because you are keeping all your money into stock that is not selling, and you will not be able to pay your other expenses. So you must go and pay attention to these calculations when you do the analysis, so that you can see what is all the possible questions that they could ask you here. So I just did some extra, what was not asked in this question, but they could also ask you this. Then the owner doesn't understand why the bookkeeper wants him to change from the FIFO method to the weighted average. So he approached you are the internal auditor, to explain to him why this is best to do this and change it. Now, if you use the FIFO method, whether you use the periodic or the perpetual method, you will get exactly the same answer. So it means it will not be different, because you always calculate your inventory that you have available, whether it's periodic or perpetual, in the FIFO method at the end of the year. The fact that he thinks you can pay less tax should not even be considered, because that is actually cheating and a way of fraud to try and pay less tax. That is not allowed in South Africa. According to IFRS, if you decide to use one method, say FIFO, then it means you can't just jump around 1 year, use FIFO, the next year weighted average. You have to stick to the same method so that you can compare the inventory from year to year and be able to calculate your profits and everything from year to year, because you use the same method. If you decide at one stage that it's going to be much easier in your specific business to use the weighted average, first of all, you have to indicate it on your financial statements so that anybody that's interested, like the owners, the employees, the banks, financial institutions, SARS, can see that you change. And you have to give in your financial statements a reason why you change from the one method to the other method. And before you can change, you first have to get permission from SARS, so you have to tell them that you want to change. The weighted average, the value of the stock changes all the time, because it's normally cheaper at the beginning of the year than the end of the year. So what is bad when you use the weighted average, you will show your closing stock at a lower price, so it means it's not the price that you will pay to replace that inventory. Where in the FIFO method, the stock that's left over in the closing inventory is the last stock that you bought. So it will be more or less the same value as what you will buy new stock to replace the old stock. So when you decide on this method, you can't just change it every time. So it's much better to stay with the FIFO method. It's less calculations in the end, but if you want to change, it can't be because you think you can not pay tax or reduce your tax, and you have to indicate it on your financial statement.